What's going on, everybody? So today we're going to be going over this masterclass. It's going to give you a little bit of an insight on essentially the Trade by Design entire program. And before we get in depth with that, I'll kind of break a little bit about myself and my story, just so you guys actually have a little bit of a background behind who I am. So my name is John Guaman. I'm a 27-year-old entrepreneur out in Miami, Florida. Got involved in the industry of trading over 8-9 years ago. Before doing this, I was working multiple different types of side hustles, jobs, doing carpentry and construction, in also the retail space and also the restaurant industry. I did anything I could to make any type of money. And once I found this industry, I was super excited because I had always seen that trading had been very lucrative for multiple different people. But I remember in the beginning, I was actually in for a shock because the first time I got involved with trading, I didn't really make that much money. My excitement kind of took over, and I made a lot of money, lost a lot of money, and I was lost for a long period of time, about a year or two. And it wasn't until I invested into myself, I got the right mentorship, I went through multiple different programs, and I gained, most importantly, a ton of experience and found what worked for me. Where over the last years, trading has given me the ability to travel the world, speak in front of thousands of people, and also educate the information here that I'm going to educate with you guys, that I've educated tens of thousands of people with, literally around the world, from Europe to Africa to Australia, and also South America, and all over North America as well. So make sure you guys take some notes. I always say note takers are money makers, and more importantly, you're not going to remember a single thing that you hear today. The only thing you're going to remember is what you write down in your notes. So I'm going to break down some concepts here that are going to be able to help you really elevate your entire trading, and hopefully it gets you to the entire next level here in our course, or I would say free program. So the first thing we're going to talk a little bit about is trader psychology, which is, I would say, the foundation of all trading. I want you to understand something very clear. Okay, 80% of the whole market is really made up on a psychological level based on your thinking, while 20% might be technical. Now, why is that important? It's because a lot of times people tend to have the fear of missing out take over, have, let's say, greed take over, have impulses, have multiple different types of, I would say, negative mindsets or overly optimistic mindsets on the charts, when in reality, okay, all of these emotions and this way of thinking can actually alter your bias and actually cause you to lose. Which is why we say that 80% of the market is psychological, because, a lot of times, a lot of people can mark up a chart. A lot of people can read a chart, just like any language. You can learn how to speak Spanish, just like how you can learn how to read any chart. But the problem is, most people allow these two emotions, specifically fear and greed, okay, to take over their whole mindset. Most people, statistically, if they win 3 trades in a row, they think they're a god, and they think that they can never get a trade wrong, so they start to over leverage. And if they lose 3 trades in a row, they tend to, okay, get very fearful. Okay, they get scared of the market and no longer are confident with their setups. So what that does is it causes overthinking, and it makes them actually lose even more money in the long term. So the way to avoid all of this is by having the right type of psychology, not having any type of emotion behind the chart, and real, I would say, not emotion, but I would say not taking the chart personal. And the way that you do that is by having a solid trading plan and system. See, your system is going to guide you. Your system is going to be the thing that's going to help you, okay, have success long term. Okay, all a system is built on should be built on mathematics, and it should be built on your strategy based off risk reward and your risk management. We're going to get deeper into that. But I want you to focus right now on finding your edge. And you find your edge by what your trading style is. There's 3 multiple different types of trading styles. The first one would be like a scalper, and that's somebody that trades on a lower time frame, somebody that is okay with a little bit of excitement happening in the charts. They just want to get in and get out of the market within a couple minutes. And all their really goal is to look for that quick 10 to 15 pip move, get in and get out of the market. Now, there's other people that are, I would say, intraday traders. They're looking for that hour to 2 hour, might even be in a trade for a whole day, based on the New York session or London session. That would be like your intraday or what most people call day trading type of traders. And then the third type of trader is going to be your swing trader, your long-term trader. This is the type of person that will be in a couple setups for, let's say, potentially days. They might even be in a trade for weeks, okay, maybe even a month. And this is what a good style that I like to trade with. And the reason why is because I don't like to trade every single day. I like to trade when the opportunity presents itself. And that might take a week, sometimes being away from the market. But when the opportunity comes, the opportunity, okay, is definitely going to be there. So another thing I recommend when it comes to trader psychology, have some sort of level of self-awareness. Okay, I think the most scarce thing in the world right now is self-awareness. Having self-awareness behind your strengths, behind your weaknesses. The reason I'm asking you guys some of these questions of, let's say, psychology and your emotion, I want you to start thinking internally, okay? Because that internal dialogue will give you a better insight of how to react correctly to the market. We don't want to predict the market. We want to react correctly to what it's doing, right? And you build that up with your self-awareness. You know, for me, I understood that my strengths were in the beginning, finding the right entries, but one of my weaknesses was over leveraging. Okay. Let's say another strength of a good buddy of mine that I helped coach, his strength was risk management. Okay. That was his strength. And it actually helped him pass multiple different challenges. But his weakness, I would say, was his confidence behind his trades. And because of that lack of confidence, okay, he rarely traded. So I always recommend for you to kind of make out a list and figure out what are your strengths, what are your weaknesses behind the charts. You know, the next thing that I would say is absolutely important is your risk management. You know, I had a mentor tell me one time, you know, when you're trying to make money, you need to move slow. Think about it. Wealth is very quiet. It's very slow versus fast money is very quick. Okay. Or I would say new money is very fast. Now, what you want to do is you want to use a combination of the two. Okay. When you're looking for your entries, you want to have patience. Okay. But when you're looking for your exit strategy, you want to react fast and quickly in order to protect your equity and in order to protect your capital. Okay. Most fools rush into the market while wise men always are slow and thread carefully in the market. I want you to think of your account right now, whether it is a funded challenge or whether it is a, you know, live account that you have right now, maybe 100,000, maybe $1,000, whatever that is. However you trade that account, it doesn't matter if it's 1,000 or 100,000. It's a reflection really of your own disciplines, of your psychology and your strategy. Just understand that it's a reflection of who you are as a person. And it's also a reflection of your management skills. I want you to think like a professional money manager, right? Money manager are always what? They're always recalculating their risk. They're always, right, patient with their entries. Okay, I want you to model what that money manager would look like. What would they think like? What would they actually be like? And what would some of their principles be? And, you know, some of the principles that we have here really break that down, like always trading, you know, 2 to 3% of your account. I think that's a little too high. I would say 1%, but I would never go above trading 2 to 3% of the account, just in general. Anything above that now would be over leveraging. And just because it's okay to do something doesn't mean that it's right to do something. You know, even myself, I've gotten in the habit of sometimes in the beginning over leveraging, and yes, it would pay off in the long haul, but in the short term, I understood that what I was doing was I was breaking my rules. Okay. The second principle, always have 1 to 3 risk to reward. Huge. Okay. You, with 1 to 3 risk to reward, you can be a, I would say, bad trader and still become profitable. Okay. All you would have to do is only win 30% of your trades and you would still win with 1 to 3 risk to reward. And why is that? It's simply because the entire risk to reward model of 1 to 3 allows you to lose 2 out of 3 trades and still be profitable on the third trade. Right? So never take anything that's less than that. Or third principle, never over leverage. That's huge. And I would say the final principle, be patient with your entries, but compulsive with your profits. As patient as you can with your entry and then compulsive with your exits. Right? Really good principles here that you can study. Okay, checklists before trading. And I always say this is important. So when it comes to trading, you should get educated. Okay, I know a lot of people tend to do a demo account and try that out. But I would say what's more important is your education and the educator. And the reason I say that is just because if you don't have the proper tools, you're going into the market blind. Okay, imagine if you were going out there and building an Empire State Building or like a huge, massive building. Imagine going into that as an architect and you never went to college. It'd be impossible to build. You'd be guessing. Do you think you could build a building that high? Probably not, right? Imagine you were a doctor. Okay, you paid yourself to go through, let's say, doctoral school, your doctor school. And let's say now you're a doctor or a surgeon, now you have to perform in some sort of way, and you can't do that. Why? Because you didn't ever get the education, you skipped through it. So when it comes to it, I would say education is key. Understanding the fundamentals, technicals, all of that is the most important part. And I understand a lot of people have to pay to get educated, but guys, I'll be honest with you, you're going to pay somehow. You're going to pay either with the time, which is years, and for some people, even a decade of their time, or you're going to pay with money. And just from my experience, from spending hundreds of thousands of dollars in just personal development and different courses that have helped me make millions, I've realized that I'd rather pay with money because there's always going to be more money out there, but there's never going to be more time. So get educated. That's number one. Number two, demo for a period of time. This is huge. Okay. Yes, your psychology is going to be different on a demo account, but it's huge to be able to have some sort of understanding behind the market and to understand the rhythm of the market. The market moves like waves in an ocean, and it has a certain rhythm to it. You'll be able to catch it after only through experience to see how the rhythm works. Okay. And the next thing, gain a strategy. What's your strategy? What are you doing? Do you have a retail concept? I'm not a big fan of retail concepts. I'll be honest with you guys. I think 99% of them are bullshit. Okay. These flag pattern or breakout retest strategies. Some of these shapes that are in the market, I think they're just there to capture liquidity, and we're going to get deeper into that. I mean, smart money, we can go deeper into that, or even Wyckoff theory. But the reality is, if it works for you, it could work for you. Just find a strategy that works for you, and then practice and backtest on a consistent basis. So I'm actually going to give you guys some insight on my strategies, just some of my confirmations, what I look for in the market, and here they are. I'm not here to hide anything. The first thing that I look for is really top-down analysis. I look for market structure. I look for some liquidity, where liquidity is sitting and why, because I know that the liquidity is going to be captured. I look for institutional candles, imbalances, time and price. So let's look at some charts and see how this is reflected, okay, in the charts. So give me 1 second as I pull this up, guys, and we'll get straight into it. So as we're looking at, let's pull up a random chart. Let's look at gold. All right. Give me 1 second, guys. Let's see if I can pull this up. I don't know why this is not sharing. Perfect. Give me 1 second, guys. 1 second as I'm pulling this up. I don't know why this is giving me some issues right now. Let's give me 1 second. As I fix this, give me 1 second, guys. Okay, cool. Perfect. Now it works. Okay. So as we go in depth with gold, let's just look at, some of my confirmations and what I was looking at. So the first thing I'm looking at is what? Top-down analysis, right? I'm looking at the higher time frame. The problem with most people is they're looking at the 1 hour. They're looking at the 15-minute. Okay. And on the 15-minute time frame, most people might be thinking in their head, well, oh my God, gold is dropping. Gold is dropping here, or gold's been dropping. And this thing looks like a nasty, nasty sell. Oh my God. Look at this trend. That's what most people think. Look at this channel here. This must be a sell. Okay. It's been selling off, so we're going to sell off. Well, that's not entirely true. If you look at the larger time frame, which is one of my favorite things to do, like 4-hour or daily, we can see that gold just in general has been on this massive uptrend from, no, this is Euro USD. Sorry, guys. Gold's been on this massive uptrend here since the beginning of October, right? And if you look at the lower time frame, so we were looking at Euro USD, the average person might think, hey, look, this looks like a sell, right? People that are trading the 5-minute time frame are thinking, hey, look, this looks like a great sell. It's going to go lower, right? Because, hey, this is the high, this is the low. So this is going to break through here and drop. Now, 50-50 guessing maybe, but the larger time frame here tells us right now in a long-term bias, this is an uptrend. And what do we always want to do? We want to trade with the trend, right? Trade with the trend. Huge concepts. Now, you're always going to have corrections that occur in the market, and I'll give you an example of some corrections here, right? Because every market is built on what? Impulse and correction moves. Every market is built on, okay, I'll break it down for you here. Accumulation, higher high, right? Higher low, higher high, higher low, and so on, and so on, and so on. Give me one second, guys. All right, here, clone here. Or the way that I like to look at it is impulse. And we can look at this on the line chart here. Show you it. Correction. All right, impulse. Correction. Higher high, higher low, higher high, higher low. It's all you're looking for in the market, right? Correction. The whole market is built simply on impulse and correction moves, right? Impulse, right? Higher high, higher low, impulse, and then we would expect a higher low. But hey, what do we have here? We have this thing called what I like to call it, a shift right here. Shift in momentum. And not all the time, but usually when there's a shift in momentum, like I'll show you in the past, like it was right here, what tends to happen? When there's a shift in momentum in any market, impulse correction, impulse correction, impulse accumulation, okay, impulse right here, shift in momentum, we tend to correct and then create a new trend. So exact same thing, impulse. Now we're looking for that correction to then potentially get us into a sell, right? So what I'm looking at, this is called market structure, okay? I want you to look at the market like waves in an ocean, keynotes, music notes. I want you to look at it like a story. What's the story? What's the story arc being told in a market? And when you understand where you are in the structure, you can scale in. You can scale in buys here. We ate all the way up over here on this trade. And now we're looking to potentially, this gives us a nice solid pullback and some confirmation, potentially catch the wave down. We caught this. I caught this at the exact bottom. I gave it out as a signal. And it went all the way up to thousands of pips. Okay. So that's the first thing I'm looking for, guys. I'm looking for top down. What is the longer story? What's the bigger picture? Some people like to go to the weekly. I do too. We're right around gold weekly highs here. We're in uncharted territory, which is amazing. I like to go off the monthly, weekly, and then daily to tell me kind of a little bit about what we're looking for specifically within the market. So, guys, look at the larger picture, find out where you are in the market structure, and then figure out where liquidity is. What do you mean liquidity, John? What is liquidity? Okay, well, for some students that want to know what liquidity is on a very quick standpoint, okay, most people trade these concepts called retail concepts. Okay, retail concepts are these concepts that, hey, look, the market moves based off ceilings and floors, right? Right. So what do most people do? They have these concepts of, hey, the market moves because of ceiling, because of a floor, and then there's a new ceiling, and then there is a new floor. All right. There are all these lines in a chart, and it has to respect these lines. Okay. I don't know why most people think that, but that's what they think. The whole market's run off, and it's not run off of these lines. The market's run off fundamentals, supply and demand, and essentially what institutions, think about it, institutions and banks are doing. It's not running off of simply just because of lines on a chart or a wedge pattern. Some people call it like, oh, this is creating a wedge pattern. It must be descending wedge. It must be breaking up or breaking down, whatever their theory is on those shapes and sizes. Well, reality is the market isn't built like that. And people that do trade like that, the market or the market makers, let's just say the people that are in control, they're after your money. They're after your one thing that you're trying to protect, but they're trying to take, and that is liquidity. Your liquidity. They're after your money. They want to take your money. What's the best way to do that? To teach you concepts, give you free concepts like this. I know JP Morgan Chase Bank teaches people and gives them free coaching behind trading. Well, why would they do that? Why would JP Morgan and certain banks give you free coaching behind trading? Because they want you to use your money so they can take it. Okay, they can legally rob you. And this is how they do it. Okay, what they'll do is they'll create this perfect scenario where most people, okay, have their boxes or have their, okay, liquidity around areas or orders around areas, okay, that most retail use. So they have their sell stop orders here, let's say, or there's sell limits here, or their buy stops right above here. They also have there's a lot of sell limit orders here or buy limit orders here, but also what else? Sell stops here. So you have sell stops here, you have buy limits here, and then you have people who are still trading here that still have the sell that they're holding on to here as well. You have people over here that are ready for that, watching on market execution, that breakout and that retest strategy. So that way they think that gold's going to go higher. And they're going to try to finesse the system. Okay. Well, this is what happens. What happens normally in a market is the market, specifically around areas of massive liquidity in usually accumulation, institutions, banks, and I would just say the people at a higher power, they know where your liquidity is. They know where your stop loss is. So what are they going to do? What they normally do is they set up traps here for liquidity to stay. And the reason why is because what if the market heads down here And this is what happens a lot of times in the market. It's probably happened to you. What they'll do is they'll bring the market down here and it'll trigger all those sell stops. So now the sell stop orders go down. And then what happens? Okay, they bring the market back up. And then they take all the breakout retest traders that think this is a retest to go down. Okay, they stop them out, stop out the sell stop orders, and then the buy limit orders. What they'll do is they'll bring the price down one more time just to screw around with them and then bring price back up. You don't believe me? Well, this has happened a couple times, right? It's happened more than you could imagine. Okay, I'll give you some examples. It happened here. Look at this nice sell to buy candle right here. Look at all this liquidity here. What did it do? All these orders here. Most people, they have their support and resistance here. What happened? Order, market comes down, triggers all the sell stop orders, and wipes them out. What else? Triggers all the breakout, retest orders, and wipes them out. Who else does it wipe out? Buy limit orders. People that thought the market was going to go high, they put buy limits here with a tight stop loss of around usually here or the last wick here. And look at what happens. They get knocked out. So they just wiped out 3 different types of traders' liquidity. Actually, more than that, you could even argue that they wiped out some buy orders here, right? Because even at this area, most people would have probably been buying. So you wiped out 4 strategies in one go. Not only that, you broke the high here. So most people that were trading here probably thought that it was going to be respected in this area, and they got wiped out. If you go in the lower time frame, you'll probably see breakout retest traders get wiped out and all of it moving forward. So why is that important? It's because I'm looking for where liquidity is going to be. Where is liquidity at? Where could they be targeting this, especially around a big news week? Well, they're going to be targeting this in a big news week around the highs and the low of the week. And look at this. Look at gold. It's been sitting pretty here for the last week. Hasn't moved. Hasn't really done anything all week, right? Since Monday, its high's been 2040. Its low's been 2009. It's waiting to capture liquidity here and here, right? So I want to be aware of that. I want to be aware of that when I'm looking at a chart. Very, very aware of that. So I look for liquidity. That was part of my confirmation list. I know where liquidity is hiding. It's here, here, and here. Now down here. Okay, let's get rid of some of these trend lines or the support and resistance. Then the next thing I look for is an institutional mark or an institutional candle. This was a great example down here. You know, down here, I liked it because you had an institutional candle. One of them that we teach actually in the Trade by Design program is a sell to buy candle. Look, this is an institutional candle right here. The Trade by Design program, what we teach you is where these institutions leave footprints. And these footprints in the market, if you can catch them, hey, look. Why? Because an institution or bank, in order for them, they have such big orders, they have to sell to buy, right? Think about it. An institution, if they have trillion, let's say $1 billion or hundreds of billions of dollars, they can't just dump $100 billion in the market. It'll completely manipulate the market. There's rules, there's regulations, there's laws. They are forced to put their orders in, but they have to hedge their orders. They have to sell to buy. So what they'll do is they'll sell 3 million, let's say, shares to then buy 10 million shares. Okay. This is smart money theory, right? Or smart money. They'll, not theory, but fact, they'll sell to then buy. And then what they'll do is they'll put 10 million orders high and have 3 million here sitting in drawdown in cells. And then what they need to do is they'll bring price back down to mitigate these 3 million orders to break even. And then you'll see another institutional like FU candle, like a long wick candle or a sell to buy candle to redo this process again. This is what we teach. So what I look for is the institutional footprints. There's a bunch of them. And specifically with gold, I see a couple institutional footprints right now that I want to look for potential buys or sells in the market, right? Once you see these potential orders or entries, they're gonna be very, very apparent to you. Okay, they're gonna be very, very apparent to you, and that's something that I want you guys to be aware of, because I see gold potentially either hop into this area here for a solid sell, or going towards the institutional 2000 level, something I'm very interested in. Why? Because it's a psychological whole number too. So guys, I look for top-down analysis, market structure, liquidity, institutional footprints, and also other different factors behind the chart. So when it comes to trading, I always say, this is the last tip I'll give you guys here. It's not just about your entry. The whole market is based off of fundamentals, sentiment. You know, if you think about it, the market is based off of, you know, inflation, because inflation is going to dictate whether rates go high or low. And that dictates trends. You know, this whole trend here is because of what? Because of the rate cuts that are going to be happening. It's not just because of, oh, you know, gold's breaking structure on the upside. Well, why is it breaking structure? It's fundamentals, inflation. It's also built on job reports. It's also built on retail. And the sentiment is now that rates are going to be dropping in 2024. So that's going to create a huge wave of what? Of momentum into the upside. Cause gold to break all-time highs. So fundamentals also tell us a story. Sentiment will tell us a story. And more importantly, the technical will just give you the entry. But when it comes to management, the entry is just one part. The other part is, how do you manage a trade? Do you not let the winners turn into losers? Do you scale into trades, which is a very smart strategy? Or are you somebody that just goes big or goes home, which isn't the smartest thing to do? Or your stop loss? What are your risks to reward? You know, are you going out there and trying to, you know, make a lot of money with a huge risk reward? Be a current trade at the end right now. You know, this right here is a 1 to 7 risk to reward. Or are you somebody that, you know, has a smaller risk to reward? Think of that, management. Think of your exit strategy. What are your exit strategies? Okay. All of this is stuff that we break down in the Trade by Design program. So I don't have too much time to break it all down, but I'm glad that you were able to hop on this free masterclass. I hope I gave you a little bit more clarity and insight, really, okay, on the entire program, and more importantly, in your trading. I can't wait to see you guys start winning. If you have any questions, make sure to drop them, and I'll see you guys on the other side. Appreciate y'all. Love y'all. I'll talk to you guys soon. Have a good one. Peace.